we signed up to take Param's course, and it really was a
Haven,
life changer for us. So
you
I
can
would encourage
wind it down. I
anyone
think we
who's looking
have
for
quite
a
a few
first
people on
generation.
here. Awesome. Hi, everyone. Adrian, are we streaming? Are we good to go from a tech standpoint?
Yeah, we're all good over here.
Awesome. Hey, Swapna, Connie, Ryan, Rohan. Karen, I know a lot of you we've had conversations with over the last few weeks, so nice to see everyone on here. I feel like we keep answering the same questions over and over again, so I really wanted to gather all the really relevant, pertinent questions and do this, and also have an opportunity to go over the deal again and give all of you the opportunity to ask us more questions. And so I'm super excited to deep dive. Well, let's get started in the interest of time, everyone. And like before, this time you'll see it's more Q&A format, right? So we wanted to do it differently and kind of cover all of the common questions we get as we're having tons of investor calls, Tommy also. And so I try to do my best with getting a lot of the repeat questions on here. But like always, we're going to have tons of time on the back end to go over any questions you may have. And I always say these webinars are meant to be educational. I know when I speak to a lot of you who are just starting out, I say, it doesn't matter if you're investing in this deal or not, just hop on here, learn. There's a steep learning curve. And so if you have questions specifically related to, say, terminology or how things work, feel free to drop it in there. Okay. That being said, let's get started, guys. Okay. And as always, we have some new members who are new to the community. So I'm going to spend a little bit of time going over, GW Capital and introducing myself. But before we get started, just a recap, guys. A lot of investing is very personalized, so we always recommend, making decisions doing your own due diligence and making decisions that align with your goals, right? And so a lot of what is presented is going to be generic, and it should be considered educational. A lot of the return metrics that you see us talk about are projected returns, and so I want you to keep that in the back of your mind. None of these returns are guaranteed. And with that being said, let's move on. So I want to spend a little bit of time. I'll first introduce myself, introduce Tommy. A lot of you have had conversations with him or have heard him speak at our prior webinars. And then we'll go into more of a Q&A format, questions that commonly come up. We'll talk about the deal. We'll talk about the tax advantages and what's changing and how that could potentially affect you. And then talk a little bit about the market, timelines, next steps, and we'll have tons of time for Q&A. So make sure you keep dropping your questions in there. Okay, so for those of you who don't know me, most of you I know really, really well, but if you don't know me and we're meeting for the first time, I'm Param. I'm a radiologist in Southern California. I used real estate to get to financial freedom, and I wanted to build this community to support others in their journeys. And we're now over 20,000 members strong. Generational Wealth MD is highly focused on education and helping physicians build their own portfolios. But as we were doing that, I realized that uh, over 80% of people in the community wanted to invest passively. And so GW Capital is where we bring vetted opportunities so you can invest passively with us. We're in partnership at over $1,500 and over 375 million in assets that we're managing. If you look at our slide decks, we have our track record in there. You can go take a look at it. I'm also super excited to have Tommy join us. And he's really been a huge support since he's been on the team. Tommy, again, I'll give you some time to introduce yourself.
Hey, Param, thank you so much. Nice meeting everyone. My name is Tommy Brandt. Multifamily syndicator started in 2021. So I came on earlier this year to help out Param. I guess I started in single family investing back in 2011, graduated to multifamily investing, started investing passively and then actively. And so I've done a little bit of self-storage, mobile home park investing, apartments, and given into plenty of shiny thing syndromes. And I'm very bullish on apartments as being kind of probably the best asset to give you consistent risk-adjusted returns at this point.
Yeah, thank you, Tommy. And Tommy is amazing with numbers. And for those of you I know a lot of you on here have either been through the program or do a lot of due diligence. Tommy has put together the underwriting video, and I believe he will be sending it out to those of you who have already soft committed for this deal. But for those of you who want to deep dive more, if it's either educational or because you really want to understand the numbers and the risk and the assumptions before you sign the paperwork, feel free to send us an email at admin@gwcapital.com, and Tommy will share detailed underwriting with you. What we're going to do today is continue with more higher level information that I think was relevant to all of you and is going to give you a good idea of why we think this deal is amazing and how we've de-risked it. But if you are someone, and some of you also work with either a tax professional or a mentor that you would like to review the deal with, and if you're looking for something that's deeper than what you're seeing on the slide deck, feel free to reach out, and Tommy should be able to help you with that.
Yep.
Okay. Like I always say, our goal is to help all of you feel comfortable shifting your asset allocation, because 90% of our returns come from asset allocation. And I would say even in 2018, 2019, my portfolio is very heavily weighted towards stocks and bonds. And what that does is that it doesn't allow us to tap into the tax efficiencies, the higher returns, and the lowering of risk in our overall portfolio we get once we start introducing alternative assets such as real estate in here. So my goal is to help break those barriers for you, and we're here to support you with any questions you have so that you get a more balanced portfolio, right? For those of you who are new to GW Capital, our goal is always to make sure we do a big part of the due diligence upfront. We're always investing in really strong markets, strong deals that are conservative and have high cash flow year one. We're also really taking a look at debt, and when we go deeper into the presentation, I'll talk about the two things that I want you to leave with, right? And whatever deal you're investing in passively at this time is to make sure that the debt on the asset is good debt with low risk, because we're going into an environment where we don't really know what's going to happen with interest rates. We also want to make sure you have high cash flow day one, which means it's already stabilized. And that really helps us in a pro-inflationary environment when we don't know what's going to happen with the cost of construction or with the labor market, right? And so we try to do all of that in our deals. We want to introduce diversification into your portfolios with really conservative deals where you're still able to tap into tax efficiencies, and with the overall goal of getting your portfolio where you're lowering risk but increasing your returns. And I really want to thank all of you for being part of the community. You support our charitable mission. We are working closely with boots on the ground, early intervention centers and healthcare professionals who are helping children with disabilities in rural India. You make that possible with everything that you guys do to support the community. I want to get started with the presentation, but I've spoken to a lot of you this week, and many of you already downloaded the guide. And before we have our calls, you've gone through the guide, you've gone through the webinar replays. And so if anyone is new to passive real estate investing and you're looking for a quick guide, there are some really amazing books, but they can take weeks to get through. This is a really quick overview for someone who's starting from scratch. We put it together as gwcapital.com/guide. Take a look at it, and it can answer a lot of those questions for you as you're starting out. And so as part of our educational mission, we're also hosting our first in-person summit at the Langham in California in October. And if you really want to, be surrounded by a community that's going to support you in your journey as you're going down this path, that's not the traditional path, right? And you want to be supported by mentors, and this is a great place to be. I'd love to see all of you at the summit. And we still have early bird pricing on there, so make sure you register for it. Okay, let's start off with the deal highlights. Tommy, whenever we get to the market, I'll hand it off to you because you are in Nashville, in the Nashville market. So, but I'm going to start off with, whenever we talk about the deal and why we like the deal, and I want you to look at it the same way. We take a look at the market first, then we look at the actual asset, how it's performing, and then the overall business plan, and put all of that together. So we'll start off with market highlights. Tommy, if you want to start.
Yeah, happy to. So this property is in Hendersonville, which is a suburb of Nashville. It's about 20 minutes northeast. I've been in Nashville for 16 years. I've had a lot of people that I've met that have even hunted me down and said, "Where should I invest in Nashville if I want to invest in Nashville in Middle Tennessee?" And my usual response is, "Don't invest in Nashville. Invest in one county outside of Nashville. That's where you're going to get the best basis." And when I say basis, I mean your price per door relative to your price per rent. right? As far as that ratio, there's so much of a land premium on, downtown Nashville, Nashville Metro, Davidson County in general. And so, yeah, if I had my druthers, I would be investing either there's two spots on the south side, either the south side or the southeast side, or the northeast side. And so this property is on the northeast side. And so this Hendersonville, Gallatin, Goodlettsville, these are all Sumner County, and these are strong markets. Gallatin is having some growing pains, and Hendersonville saw the writing on the wall long before them, and they basically, we're going to talk about the supply and demand imbalance here in the market and how it has the exact opposite issue that Nashville has, which is oversupply. Because they saw this coming a mile away, and they were just like, there's no way our infrastructure can support 10,000 additional units. So one of the slides we have on here that's actually really exciting is it shows you the number of new deliveries coming online, and it's like the size of our property, right? There's 250 units coming online in the next 12 months, and this property is a 232 unit property, right? So there's one more property coming to market, whereas Nashville has 20,000 additional units, and I think 30,000 last year was the metric for Nashville. And so, Nashville has been a hot spot. You've probably seen it in some headlines here. But the very first two things we look at when we're considering a market or considering an investment is population growth and job growth. And Nashville is well above the national average on both. If you look in it's just funny. If you start at the end of our slide deck and go backwards, that's where you see all the new developments, like specific projects named. But historically, we've been in eds and meds. Kind of the economics there. That's why we didn't fluctuate a whole lot back in 2008. Since e-commerce has been booming, logistics has been a big deal in Nashville because you can get to 70% of the U.S. within 1 day's drive. I don't know who has number one or who can beat that. I think Columbus, Ohio has like 50 something percent, but it's up there, right? And so from a logistics perspective, it is very attractive. And then most recently, we've been getting some attention of tech. So Oracle has signed a lease for some land in downtown Nashville. They've been slowly mapping out their campus, and Facebook is building a data center on the other side of Hendersonville, which we're hoping to attract some high-paying tech employees whenever that gets done. But yeah, like a $1 billion data center going in like less than 20 miles away, just northeast of us. So pretty pleased with the market, pretty pleased with the high barrier to entry for other apartment complexes. What that means for investors is we do expect above average rent growth. We're not going to underwrite for that, but that is something that we anticipate probably to look closer to like 5 or 6%. There's some economists that think it's going to get over 10% rent growth nationwide as the supply and demand imbalance hits, since it has been prohibitive to build new in this high interest rate environment, high expense environment. But I'll pause there.
Yeah, I mean, I think we can keep going on and on because there are so many data points. The slide deck covers all of that, guys. And we did, Tommy actually did a great job going over the market specifically in more detail with the first webinar, so you can take a look at that. But we'll have some more slides on the back end where we really deep dive a little bit more into the markets. But this is just an overview, right, before we get into more questions that we've been getting. And so similarly, as far as the deal per se, again, we're looking at risk, and I spoke about this when we did our State of the Market webinar more recently. In the current environment with tariff uncertainty and interest rate uncertainty, what we're trying to do is eliminate variables, which is what we're doing with this deal, right? We have an amazing 4.89% interest rate, agency debt that we're assuming from the sellers. So that puts us in a strong position, which is why we're able to get, slightly over 5% cash flow day one, right? It's very hard in this environment. And so again, all of this varies depending on the market cycle, right? So in this market cycle, to have positive leverage and to have that degree of cash flow is very hard to come by, right? So that's something we're doing. We're eliminating the variable of interest rates over there. And again, this is an asset which is completely rehabbed. Sellers replaced the roof in 2024, and we're eliminating the other variable where we're putting capital in and trying to bump up rates, the rents, and see where we go with it, right? So again, eliminating variables is a big part, and so it's also an asset that has over 97% occupancy over the last 18 months. And again, this is what Tommy was talking about, right? That speaks volumes about the supply demand in that submarket. And that's something we want to be intentional about, because the next few years, certain submarkets, even really, really strong submarkets, will just be hit with more supply. And that's going to drop occupancy in the short term, right? It's all in the short term. But again, that's something we want to be intentional about. Right? And this is an asset with high occupancy, and a lot of the variables have been eliminated. So The business plan, again, is very simple, which is what we love about it, especially for this part of the market cycle. There is close to a $400 gap in terms of what the property is currently renting for and what it could command. And over time, we're just going to, it's called burning off loss to lease, is just catching up with market rents. And that's what we're doing. In addition to that, we're going to have small things that we're going to do to boost the net operating income, installing washers and dryers, and then the rest of it is just going to be organic rent growth based on, especially if we're going into what we assume will be a pro-inflationary environment and in a submarket where there is lower supply, we're anticipating organic rent growth to happen. And again, we're being very conservative in our assumptions over there, but that's the business plan. And so you'll see it's not something where we're building from ground up or dumping a lot of capital in and expecting to bump rents up. That can be a little tricky, in the current economic environment. So, we're being very conservative over there. And, we just spoke about this. I think it's important to remember this, even as you make decisions and you're analyzing other projects. Those are the takeaways for us. And it's definitely a slightly different environment from, say, last quarter, right? Because of whatever's happened with trade policies and tariffs. But that being said, yeah, it's something we're very intentional about. Now, the positive, and we'll talk about when we talk about tax returns, is that we are hoping that within the next month, we'll probably have more direction in terms of what's happening with 100% bonus depreciation. So it's also like pluses and minuses, right? So we are expecting more of a boost when we have all of those additional tax efficiencies if the law gets passed. But that's something we're still waiting on. Okay, so something we get a lot is in terms of the returns, right? So how are our returns higher for GW investors compared to a retail investor? We were able to negotiate, and this is something we've been doing consistently. For those of you who already invested with us, you've probably seen us do this. Most investors in the deal who go in with a $50,000 check, which is our minimum investment, we'll get a 7% preferred return and a 70-30 split, which means that, for every year that you're in the deal, although you may get, maybe 5% year one from cash flow, on the back end, right? We want our investors to get if you had a 7% preferred return, we want you to get 7% for every year that you're in the deal before the profit is, the profit split happens on the back end, right? And so that's something that prioritizes our investors. Now, for GW investors, for Class B, we were able to negotiate an 8% preferred return, and the profit split also is more favorable, where instead of getting 70% of the profit split on the back end, our investors get a 75%. So a higher profit split. And so that's how you're getting higher returns as a GW investor. And if you have more questions on that, guys, drop it in the chat and we'll get to it on the back end. And so these are slides that are there in the slide deck. If you go to gwcapital.com/Nashville, we'll talk about equity multiple, what's the average cash flow from the deal, what your average annualized returns are. It's a great way to maybe compare deals. When you're comparing two deals, I always say, look at the return profile and also look at the risk profile. And we'll talk in a little bit about what the risk profile for this deal is. But if you're looking for these numbers, you can find them in the slide deck. Now, Class A, I'll talk more about that later, but the Class A position is more for people who prioritize cash flow today. And a Class A investor gets about, is projected to get about 10% for every year that they're in the deal, as opposed to Class B and C investors who get lower cash flow upfront, right? And all of this hits your bank account every month. All of this is tax-free. I want you to keep that in the back of your mind because that is significant, right? If I got 5% from a CD or a savings account or money market fund, I would be paying, for me, at least in California, over 50% in marginal taxes. All of this that hits your bank account is tax deferred. And then there are strategies on the back end where you can keep deferring taxes, right? And you can see the average analyzed returns over here. So this is available to you. We also have a slide deck here which shows you what your returns are for a 100K investment, just to keep the numbers simple. For A and B, and the reserve class is a 500K minimum to get enhanced economics. But you have all of this available to you. This is what the numbers would look like, on the back end. So this is what you would get from cash flow, and then there's the additional equity split, and so what your total returns are. So take a look at this if you have any questions. Just drop it in the chat. We can go over it in detail. Now, also remember that this is a great educational point, right? Tommy, do you want to just take this, the sensitivity analysis and how they should be analyzing taking a look at this?
Yeah. So some of the questions that came up is how do we stress test our underwriting? Today I was going through illustrating how on a monthly basis, right? We have 48 months where we're calculating and projecting, what is our income, what is our expenses, what is our debt service, what's the cash flow to investors, rolling that up on an annual basis. And so the question was, how do we pressure test this? And there's a couple different ways. So what we're highlighting here is it's called a sensitivity analysis. And so you can do a sensitivity analysis with a couple different metrics. You can do it with NOI to see if we're below target or above target with NOI. How does that compute to my target projections? And in this case, this is cap rate, which the concept of a cap rate you can think of as like a market multiplier. Whenever a market is more desirable, it has what's called a more compressed cap rate, which means that there's a larger multiplier on the profitability for the property relative to its purchase price. And so what we're illustrating here is we're stress testing a non-controllable versus a controllable, right? So cap rate is something we have no control over, right? That is just whatever the market can bear or whatever the market makes sense. If you want to know a cap rate, ask your local commercial real estate broker what the cap rate is for your market. Maybe that's a fun fact or a fun conversation for the day. But what we're illustrating here is what's the impact to your returns if the market is better than we think it'll be, or than worse than we think it'll be. And so we're kind of right in the middle. So we're targeting that the cap rate for the market is going to be a 5.5. That's not going to mean a whole lot to whole people, but we do think that we are at the top of a debt cycle, and somewhere within the 4-year period that we hold on to this, we do think that the interest rates are going to lower, that the market desirability is going to continue to get better, and that somewhere in there we're going to navigate and find a time to land the plane and find a great opportunity to get a good valuation for our asset.
Yeah, thank you for that, Tommy. And I love looking at these numbers. I love looking at what the assumptions are. And so like I said in the beginning, right, all of these numbers are projected returns. But if you really want to see, okay, with these variables, right, if we're in different parts of the market cycle, what do my returns look like? And this is a great slide to go and take a look at, right, to see, okay, how would things shift? And then again, if you want to deep dive and hop on a call with us, either me or Tommy, we're more than happy to walk you through it so you understand it better. Okay, awesome. So like I said before, right, this is a deal, and in this part of the economic cycle, we like being in deals where we're eliminating some of those variables, right? So we're not really going in value adding, and when you have a value add deal, there's slightly higher risk or new development. So this one's definitely on the lower risk part of it, which I think is a great asset for us to acquire at this part of the market cycle. It's what we call a core plus asset. And so a lot of you have asked how this slide works, right? Hey, how are we getting $11.5 million increase in value? What are we doing to get that? And so when we've done our portfolio presentations in the past, I've showed you how, in an asset so this is one of the assets we had in Greenville, South Carolina. We executed a water savings plan where there was a $45,000 savings, annual savings, just because of the plan we implemented. And that translated to close to $1 million value increase, right? And that's because in multifamily investing, unlike single family investing, the asset value is determined by what your net operating income is, right? So the income that you're generating from it, because we're all investors, and it's based on that, not based on what your neighbor was able to sell the property for. And so if you look over here, if you look at this chart, and then Tommy goes over this in more depth when he did the underwriting video, you'll see that there is a bump in the net operating income, from the time we acquire it to when we anticipate to sell it. And that bump, which is, I think, close to 600K, if you factor in that increase in net operating income, that's what's able to deliver this increase in value. And that's the beauty of multifamily investing, right? Which is why we go into projects where, like in this particular asset, we're doing that by adding washer and dryers to the units. It's to buy the loss to lease that we talked about, where rents are on average about $400 below what we can command, given current market rents. And that's always happening, right? Because as rents go up, there are tenants who need to get out before we can, or who need to have their leases renewed, or when we re-tenant it, that's when we're able to actually bump up the rent, right? And so all of that considered, so the loss to lease and the small value add plan that we have for the project, that's going to give us a bump in net operating income. That also factors in some organic rent growth, right? And those assumptions are also in the underwriting model, and they're conservative. All of that factored in gives us this value increase over time, and that's where the projected returns come from. Okay, so that's what we just addressed. How do we, bump up value? And then we talked about returns. We talked about some of the assumptions, and I guess the big question is like, how conservative is this? How are we de-risking it? And some of these things we already talked about. The debt is a big part of how we de-risk the deal. It is completely rehabbed. So again, we're eliminating the variable where we're pumping in a lot of dollars into each unit to bump up rents. And bumping up rents can also be tricky in the current economic cycle. In some of the assets we've acquired in the past, we've had to pause that because we aren't seeing the same rent bump when we do like a full platinum rehab versus just turning the unit, right? And so in this is a completely rehabbed asset, so that is out of the equation. This is also an asset where we have high cash flow year one. Tommy actually goes over how we stress test it, right? And even after stress testing it, we're still positive cash flow, right? And so we have positive leverage because the interest rate is low, and we're still able to get an asset that cash flows heavy year one, which, like I mentioned, is hard to get in this economic cycle. We also have a discounted purchase price. We got this asset off market because of our relationship with the broker, and there's $1 million discount. All of that means there's added equity when we go in. And then other numbers we'd like to look at. If you've read the guide, then these numbers make sense. Break-even occupancy is like, how much does occupancy need to drop? And it's currently on average close to 97%. It needs to drop down to 67% or lower for the asset to stop being cash flow positive, right? And so that's a very, very healthy number. You typically want that to be, um, you know, um, 80% or lower. And then DSCR just means, relative to how much we have to pay the lender, how much cash flow do we have? So 1.65 means we have 65% more cash flow from, the net operating income is 65% more than our annual debt service, which is a very, very healthy number. And those are average numbers. Okay. Like we mentioned, Tommy talked about this when he talked about the market, minimal new supply, that is huge, right? And it's a great a sub-market, A-rated school district. And like we said, there's an erosion of housing affordability across the country. And that just favors, more and more people want to rent rather than buy. And that just gives us healthier occupancy numbers. Okay. Moving on, we talked about the gap, between what someone has to pay to buy a property versus how much they would pay for rent, and that gap is what makes renting more favorable right now. Okay, debt terms. We talked about debt terms. It's a loan assumption, 4.89% fixed interest rate. 70% loan to value, which means we're taking 30% equity, 30% down payment goes in. All of that adds to the health of the asset, as opposed to, say, we had a 90% loan on the property. In different market cycles, you could be upside down, and that could be a very tricky position to be in. So very healthy debt terms. Debt is a big part of the equation, so that's important. Tax savings. Tommy, do you want to go over the tax savings?
Yeah, absolutely. And so I guess there is the Jobs Act, which is kind of phasing out bonus depreciation right now. We're hoping that it got passed in the House. We're hoping the proposed bill gets passed in the Senate, where that would be reinstated for the year of 2025. And so we're on the edge of our seat. We have gotten some preliminary cost head quotes. Effectively, for every $100,000 invested, it would yield about 30% or $30,000 worth of passive losses. If we actually crunched the numbers, if bonus depreciation got passed in the Senate and that was retroactive for January 1 of this year, the losses would be closer to like 60 to 70%. I'm trying to manage expectations on the low end, but still, like 60% of your investment to show as a paper loss, like that's incredible. If you were around investing in 2020, 2021, you probably saw slightly higher numbers because there was higher leverage. But we're happy to have low leverage and still be around 60% of paper losses of an investment. Generally speaking, the bonus depreciation has garnished bipartisan support. We're just waiting for the terms and negotiation to take place between both parties before this kicks off.
Yeah, thank you for that, Tommy. And that's such an important point. You should also look at the leverage on the asset when you're comparing, the bonus depreciation you're getting. So it's an apples to apples comparison. Okay, so something a lot of you ask is, Param, I am both of us, have full-time jobs, we're W-2 earners, and, does this really help us? And I think what I want to emphasize is that these losses, paper losses, cannot be taken against your W-2 income. unless one of you qualifies for real estate professional status, which is a rigorous criteria. Some of you may have spouses who are, in the real estate space, and you may be have spouses who are part-time, who are really spending a lot of time on real estate. And so need to have 750 hours in real estate in a given year, and more than any other income producing activity, and also hit material participation separately. But for those of you where you have, two physicians or two professionals who are working full time, or don't meet criteria, know that it's still very, very significant to have bonus depreciation, because it helps you during the whole period and on the back end in multiple ways. So remember how I kept saying, hey, if you're getting 10%, cash on cash, and it hits your bank account every month, that is tax free because of the losses that you see on your K1s, right? So that ensures that even though there's money hitting your bank account, you're not paying taxes on it. And on the back end, there are ways to continue. So most of the deals we've gotten into were very intentional about having language in the PPM that allows us to do a 1031 on the back end, where you can exit the property and still defer having to pay capital gains or depreciation recapture, right? So you still benefit from it. If you're someone, all of the if you structure it right, all of the cash flow, all of the capital gains, the equity, the profits that you get on the back end can be tax free, and you can use it to keep, adding momentum to your plan, to snowball your strategy. And so everyone benefits from the tax savings. All right, I want to keep that in the back of your mind. And then for those of you who own other real estate, all right, a lot of you on here, I know I've had conversations with you, own other real estate. If you have other sources of passive income, some of you will have part ownership in endoscopy centers, in dialysis centers, and part of that income comes to you as passive income. You can use these passive losses against anything that generates passive income. Some of you have short-term rentals where year two, now you're not materially participating and it becomes passive income. So any passive income you have, you can use the bonus depreciation losses against. And so there's time value of money. So you're not waiting to use it, using it up front, reducing your tax burden today, taking those dollars and reinvesting them, right? So even if you didn't have any other source of passive income, you would be using your bonus depreciation losses against your cash flow during the whole period. And so now you have momentum because you're not paying taxes on it. And there are strategies on the back end to defer it. So I want everyone to keep that in the back of your mind. Okay. Detailed underwriting, like I mentioned, admin@gwcapital.com. If you guys want it, just email us. If you've soft committed, we will be sending out detailed underwriting to everyone who's soft committed, along with the spreadsheet, as well as the video walkthrough that Tommy did for you. So just let us know. And we go over risk, debt, the assumptions, all of that, so you have a better understanding of where these numbers, the projected returns are coming from, right? When do distributions start? It's going to be after the first full month of ownership. So say we close end of July, August is our first full month of ownership. Around mid-September, you should see the distributions for the month of August and prorated distributions for July hit your bank account. That's typically how it works. And so after you're done with all your few paperwork, we want you to integrate your bank account. You'll be prompted to integrate your bank account to the portal so that it can be a direct deposit. A lot of you have questions about IRA funds. Yes, you can use IRA funds. And if you need an IRA custodian to assist with that, you can email us at admin@gwcapital.com. We can connect you to our preferred IRA custodian, and they can walk you through it. They've done this for many of our investors. Why are the sellers selling? They are, the asset is part of a fund, and they have timelines where they had projected an exit, and that's why they're selling. What is the expected hold term? Tommy, do you want to take this one?
Of course. Yeah. So our hold term here and our projection here is dictated by the loan terms. And so there's a little bit more than 4 years left on that very attractive debt. And so by the time that we close, it'll be right at 4 years. And so we do anticipate this to be a 4-year project as a result of that. There is a world where if things look really, really good, we could refinance and pull out all of our principal and still hold the asset. But I'm just trying to manage expectations that we're probably going to be selling by the end of the term, or sometime before. But yeah, I don't anticipate a refinance. We'll see.
Yeah, we aren't underwriting for that now. Again, we don't know what the market cycle is going to be 4 years from now. Knowing where we are in the market cycle right now, we're already headed towards the upswing with rents going up, interest rates beginning to drop. But just knowing that this is an asset that cash flows heavy. Worst case scenario, we would refinance it and hold on to it, like Tommy mentioned. But the plan is for an exit in 4 years. Minimum investment is 50,000 for class A and B, and then reserve class is higher because you get enhanced economics when you invest more. Class A or class B, I guess I touched upon this. Class A is typically for the safety seeker, and this is someone who either is risk averse, wants a lower risk position in the capital stack, right? Class A investors get paid right after the lenders, and class B and C get paid out when after class A investors get paid out. So there's lower risk in it. It's high cash flows. It's great for someone who is hoping to live off of their investments. This could be someone who's cutting down to part-time, someone who is getting really close to retirement or is living off of their cash flow, right? And so something to keep in the back of your mind. They do not get a portion of the profit split on the back end. A lot of you though and class A has a smaller allocation, and so if you are interested, Class A is getting pretty close to being, full in terms of the soft commits. And so if you are considering Class A investments, then I would highly recommend going in and submitting your soft commit and actually getting on the portal and getting to the point where you're signing your paperwork, because it is a smaller allocation. It fills up really quickly. And so, yes, so that's a takeaway for those of you considering it. Now, Class B is great for someone who's looking for velocity of growth, right? If you're someone who says, okay, we're a two-income household, we're young, we're growing, we're going to be earning for quite a bit, and I really want velocity of growth. I want my capital to make more money. I want that profit split on the back end and higher returns. And I'm okay if we don't have, as much cash flow as Class A gets upfront, then Class B is what makes sense for you, right? Okay, questions about the fund. GW Capital Fund 1, it's a completely customizable fund. It's not a blind fund. You get to pick and choose every investment you're in and how much you want to put in. It allows you to get diversification and streamline your experience, right? So you're tapping into the tax efficiencies, you're getting diversification, but end of the day, you get a single K1. You don't have to download multiple K1s for each investment. And so it keeps it simple. Now, for this deal, we are not taking any due diligence or asset management fees for this deal from the fund per se. And so we're passing on all the benefits to our investors. And we have reduced the cost of the fund significantly, which allows us to kind of absorb the cost and pass and give our investors enhanced economics. And so has always been our goal. It's not guaranteed for every deal, but so far that's what we've been able to do. Okay, how much equity do GPs have in the deal? All the general partners in the deal are putting in their own capital. I typically put in 6 figures of my own capital, and I'm doing that in this deal also. And so we are aligned. And honestly, I've actually stopped growing my personal direct ownership real estate portfolio, and I'm just funding all of our deals that we go into. So I'm putting my money right alongside yours. Next steps and timelines. Tommy, do you want to take this one?
Yeah, absolutely. So our deadline for soft commits is by the end of this week. And so if you have interest, we're basically asking you to let us know, because sometimes the later on it gets in this process, the harder it is to make sure that we can reserve that spot for you, especially with Class A, just given it's like 10% of the entire allocation, which is almost nothing. I know it sounds like a lot, but it's not. So as far as the funding deadline, it is going to be June 15th. I don't want to spoil, but we're going to have a surprise that comes out next week for those that fund early. So if you want to be part of that group, you can get a little bonus that we'll release more information on next week. And then the closing date right now is targeted the end of July. The loan assumptions can take a little bit longer to get everything sorted out. So we'll see if there's going to be a delay. But as of right now, that's the schedule. And so, again, the target funding date is June 15th. Friendly reminder, this is first come, first serve, and nothing holds your spot more than actually funding.
Yeah. And then our fund is a 506c fund, as is the deal, which means you need to be an accredited investor. And there's more information on this in the emails we send out. And if you have more questions about this, let us know. But you do need to be an accredited investor to invest in the deal. So something else I get asked a lot is, do I need an LLC to invest in the deal? And so again, the answer is it depends. Now, all our investors are limited partners in the deal, and the reason they call limited partners is because you have limited liability when you're a passive investor in the deal, right? So your liability is limited to your investment in the deal, and that's just the way the LLC is structured. Now, the majority of our investors invest in their personal name, but there are some who do invest through an LLC, and an LLC can give you an additional layer of protection. And then there are those who don't want, they want their LLC return, their investment returns to be separate from their personal tax returns, and so that's how they want it structured. So it's a great question to have a conversation with your attorney or your financial advisor. But that's the lowdown. You do get limited liability protection as a limited partner per se, just the way the LLC is structured, and then the rest of it is personal choice. Okay, Tommy, I'm going to go over some of the market and deal slides. If you want to take over and just let me know how to assist you.
Yeah, absolutely. So it's interesting. So this asset, it is built in 1985. I'm glad that and I have a 1960s property, and so it is wrought with old plumbing and electrical issues. And man, I'm just glad to be past all that with this vintage. And so it's funny. This is an older asset, especially compared to anything that has been built new. But the amenities are on par, with what you would experience or expect in an apartment complex today. So amazing clubhouse. I was just there last week. The clubhouse, it looks just like the picture. Is fantastic. They're in the middle. The tennis court, we're planning to paint some, or toying around with the idea of painting some pickleball lines on the court. But strong community amenities, strong things to draw young professionals in, as well as medical professionals in, which is their current tenant base right now. So. The property is 1 bedrooms and 2 bedrooms is the floor plans, but the recall we are inheriting fully renovated units, and so these are stainless steel appliances, granite countertops, so these are fantastic. So sorry, yeah, I'm just going to let you digest the amenities on the side that walk-in closet. So you can see the gap in rents just there in the bottom highlighted, right? So there's the in-place rents versus the market rents, and so we actually have a slide where we break that down by floor plan because there is a lot lost in the word average, but you'll notice that the gap is still fluctuating between $300 to $500 depending on the floor plan. So our property is actually right off the strip, the main road through town. So as far as, it's not off in the corner of town of Hendersonville. So I actually really like the location relative to the submarket. So here's a slide that shows you the gap in rents between the 1 bedrooms and 2 bedrooms. Even just like the next closest comparable, right, is multi-$100, which is kind of unheard of. It's not something you would expect the sellers to just kind of let their foot off the gas with regards to pushing rents, but they had hit their metrics. They were comfortable and they just wanted high occupancy. What high occupancy should say to a savvy investor is that there's room to push rents. That they've been at an over 95% occupancy for like 12 or 18 months, and so that alone should tell you that there's room to push rents. We don't want to capture the full gap of loss to lease here, right? But we do think that with a little bit of additions and strong positioning, and we'll just carry on the rather stellar reputation that this asset has in that market. We're just going to continue to move the ball along.
This is something you talked about previously, Tommy, where we talked about the supply, and we said that there are very few units hitting the submarket, and that really helps us with keeping occupancy high and with our business plan of getting closer to market rents. And so replacement costs, again, this is something in this environment where with labor market shifts and with the cost of construction going up potentially, it's important to note that building new is going to be significantly more expensive. And as the cost of construction goes up, as the cost of new builds go up, then automatically there is an increase in the value of existing assets, and that's what we're hoping to tap into also. Hendersonville, great demographics. We always look at average household income, and the higher this really substantiates our plan to bump up rent, right? And 75% of the renters have white collar jobs. Again, a great tenant base, something we look at closely. Tommy, do you want to talk about the market drivers really quickly, and then we're going to wrap it up and we'll do a Q&A.
Yeah, absolutely. We've kind of already talked about the attraction to Hendersonville. What's interesting is that that's one of the few cities that's lakefront, and so that's contributing a lot to the high median income. There's absolutely a lot of things for people to do. We're talking about community amenities for the broader community, not our apartment community here, but there's plenty of stuff to do. Accessibility is fantastic. A lot of people move to Tennessee not just for the no state income tax, but also the outdoors life. So there's a lot for people to do here in just the market. And like I said, it's 20 miles from Nashville. So commuters can still have access to Nashville without paying twice the rent. So. All right.
Yeah.
Yeah, the kind of a repeat there. That there was a snippet of the Facebook data center on the last slide for those that are interested in it. Yeah, speaking of lakefront property, if you look at the pin in the kind of the top right corner, that's our property relative to these $1.5 to $2 million houses. And so whenever we as far as our evolution for investments goes, we definitely want to be in more affluent markets. Find that those are just more resilient. There's more room for expansion and compression, and so yeah, we're happy to be there. Yeah, and in case you didn't know, Nashville has been on an incredible growth spurt. So check out some of those stats at your leisure of just the growth trajectory that Nashville has been on over the past 10 to 20 years. Yeah, so Tennessee is a no state income tax. That is pretty nice. There's tons of tech. I forgot Amazon when I mentioned tech. But yeah, you can kind of see the economic impact that's going to have just from new construction plus operational income plus the spend throughout the city.
Thank you, Tommy. I want to wrap it up before we go to Q&A with, the biggest question is like, is this a good time to invest? Which is what we get a lot, right? And you oftentimes, when we are at the peak of the market cycle, that's when everyone wants to invest. It's also a time of maximum risk. When we are at the bottom of the cycle, that's when there is more opportunity, but it's also, that we're actually de-risked significantly. But that's also a time where investor sentiment is mixed, and sometimes, it's not always pro-investing. And so I always say lean into the data. We know what the forecasts are going forward. And all of this didn't even factor in tariffs and trade policies. And so if we are going into a pro-inflationary environment, what you want to be investing in, right? The asset class you want to be in are essential, real assets, which are cash flow positive, which, and multifamily investing is at the forefront over there. And so we're perfectly positioned to tap into it. This is a time where I think the natural tendency is, hey, let me keep my money safe. I want liquidity. I want cash. And we want to invest in some of those, safety, the security bucket, the bonds and CDs and fixed income assets. But I think really thinking about the tax efficiencies over there and thinking about what happens in a pro-inflationary market is that once you factor in taxes, these are very tax disadvantaged and oftentimes they don't keep up with inflation, right? So you really want to position yourself strongly. And I will leave with Warren Buffett's quote where he said, rightfully said, be fearful when others are greedy and greedy when others are fearful. So this is what we've been talking about when we talk about this asset, right? Cash flow day one, the right kind of debt, conservative assumptions in a great market. That's what we're investing in. That's what this asset brings. And when you are investing at the bottom of the market cycle, you do get outsized returns. So, okay, timelines, just to recap over here. The soft commit deadline is more to get a guaranteed spot, right? So after that, you get on the wait list, and we will let you know, as availability opens up. But if you want to get a guaranteed spot, then May 31st is the date of soft commit. Like Tommy mentioned, the funding deadline will be June 15th, and we're hoping for an end of July close, and we'll keep you posted as far as that goes. And then again, the wrong link on here. It's gwcapital.com/Nashville, and you can book a call. To talk to Tommy or me. And if you have more questions, if you want to go over your personal situation, see how this fits into your portfolio. And we're more than happy to support you with that, because like I said, what class you invest in, how much you put in, how you think about asset allocation, all of that is going to be very different for you, even for you at different points of your investing cycle. So, and if you have other assets and you're trying to strategize around taxes, all of that, we're more than happy to support you. So you can book a call with us. Okay. Awesome. Let's get to Q&A. And thank you guys for hanging out with us Thursday evening. My kids, this was the last day of school for them, so I know a lot of families are potentially traveling, so it's that time of the year. But
Yeah,
let's
and
see.
there's a couple that have come directly to me. I don't know if you've had that as well.
Oh, okay. Awesome, Tommy. Do you want to just go through the questions then maybe, and then I'll hop in when I need to? Because I know you've
Sure.
been answering them on the site also.
Yes, yeah. So if I seem distracted while presenting, it's because I
No
suck at
worries.
multitasking. So apologies in advance. Yeah. So Tammy asks, could I learn your track record of performa versus actual? And so we do put our schedule of real estate owned towards the end of the presentation, so that's available. But yeah, happy to follow up with you after the presentation
So, Tommy,
and
you could
get you
probably
that.
send her the webinar link that we just did where we went over all of that, which
Okay,
also has that PDF, so that would be helpful.
understood. Ines asks, what does soft commit entail or mean?
I see that you already answered that. So it's non-binding. I tell our investors that even when you sign the paperwork, we've had investors who come back and say, "Hey, Param, you know what? I just found this great property and we want to buy a new home." None of it is necessarily binding until we close on the property because then, you're part of the LLC and then it's a legal document. But it does hold your spot. And then once we get filled up, especially for Class A, we're going to fill up really, really quickly. You won't be able to get into the deal if you haven't reserved your spot. So it's a way to reserve your spot, and then you go ahead and move on to the next step. So
Yep. There's one question of what's the market cap rate in the area? And so just for visibility, my response was it's for that area is probably going to fluctuate between mid fives and mid sixes, depending on how far out in the town you're getting, what is the vintage for the asset. I'm placing this one at right at a 6. And so we're buying at 6.18 is our year one cap rate. So that shows you we're buying at a little bit of an advantage relative to the current cap rate.
yeah,
Yeah.
great. Great answer. Spot on there, Tommy. I have a question that was directed to me as a direct message, so I might as well take that because
Sure.
there's no way you could have answered it. And it's a repeat of what we just discussed. As a W-2 income earner, how do I benefit from the tax savings is what I got. And it may have been prior to my actually explaining that. But like I said, your income, right? If you're a Class A investor and you get 10% from cash flow hitting your bank account, or as a Class B investor, year one, you get 5%. All of that is tax free. You don't have to pay taxes on it. And that's significant, right? And that happens if you're a W-2 earner, if you do not have real estate professional status, it doesn't matter, right? So you get to benefit from that. And so as your portfolio starts scaling, you'll realize that all of that passive income you're generating is tax free, which really starts adding momentum. So I also mentioned this for those of you who have additional sources of passive income, either from a short-term rental, a long-term rental. Sometimes people, I've spoken to a lot of our investors who have long-term rentals that are completely paid for. They tend to be very tax inefficient because your depreciation is not offsetting your cash flow completely. And so you can use these losses against other sources of passive income, be that short-term rentals, long-term rentals that are paid off completely. With short-term rentals, you have so much cash flow that most short-term rentals, especially if you bonus depreciated in year one, you're going to have positive cash flow that you're paying taxes on at your marginal tax bracket year two onwards, right? So all of that can be sheltered if you have passive income from your interest in a surgical center, endoscopy center, dialysis center, all of that income you're paying marginal taxes on, that gets sheltered because now you have these losses. And so there are a lot of benefits. So that's something to consider. We also have we have a podcast episode where we talk about these tax benefits for investing in passive investments. And I cover a lot of this in detail over there. Adrian, if you can just grab a link to that and drop that in the chat, that'll be helpful. But if for those of you who are listening to this later, it's the Generational Wealth MD podcast, and it actually says tax benefits for passive investors, I think, or tax strategies for passive investors is the heading. Okay.
Awesome. Great. Do you have any other ones?
Um, I think there's a question about the square footage of a two-bedroom, which is on the slide deck, guys. And Adrian, if you can drop a link to the slide deck in here, then that would be helpful. That's all I have, Tommy, on
I
my
got
end.
a
That's what
couple
I have
more.
visibility for. Go for it. Mhm.
Yeah, yeah. And so I think this was going back to your slide on the asset protection and liability there. But as a limited partner, what liabilities do they have personally?
So their liability is limited to their investment in the deal. So if you put in 50,000 and there is a major lawsuit, and we need to liquidate the property, I mean, so this is like worst of worst case scenarios, right? And it's because usually we have insurance and we have an umbrella insurance, so multiple layers over there. Nothing can touch your investment. So this is where we talk about a limited liability company has inside protection. So whatever happens within it stays within it. It cannot come outside. And that's the whole point of creating a limited liability company and maintaining corporate veil is to ensure that nothing from within it can come and attach to any of your other assets. And so they're structured in a way that your liability is limited to your investment in the deal. And so everything else is protected, which is what most people are concerned about.
Yep, great. Appreciate the covering that. Some other people I've seen are the presentations from our other general partners on this one. Do you want to talk about the relationship with Viking briefly?
Yeah, we have a great relationship with Viking. Vikram and Ravi are great friends, and so we are all general partners in the deal. And so it's mostly physician-led general partners. And I think that the major difference is that we're all involved in acquisitions, underwriting, asset management, and investor relations. I think the biggest difference is that because we now go through GW Capital Fund One, where we take a single check to the table, we're able to negotiate higher returns for our investors. And that's the slide where we covered that. You get a higher preferred return and an enhanced profit split as a Class B investor with GW Capital. But otherwise, if our investors, your communication will be coming from us. We have quarterly Zoom webinars where you have the ability to hop on the call with us. We go over all of our portfolio's performances, and we can pause and have face-to-face discussion. So you have that. Tommy and I are here to support you, and Adrian. And so yeah, so your communication will be mostly with us. You will be on the GW Capital Fund One portal, which is cash flow portal. And so you'll get a single K1 no matter how many deals you invest with us. We work with multiple partners, and Viking is one of our partners. So you have diversification over there also, both geographically and operationally, which I think is a strong suit. So.
Yep. Great. Appreciate you touching on that. The NS asks, what happens? This is a fun question. What happens if you don't get enough investors?
So typically, we've had to get to the point where we can't take investors in. And just based on the momentum we've had in this deal, both for us and our partners, and we keep doing multiple spot checks, we don't anticipate that to be an issue, just given the momentum we have in this deal. Let's see, what if the worst case scenario, I guess. So we always have the ability to put in more GP equity if we need to. We've never had to do that to date, but there's always a way to put more GP equity into the deal and then backfill it on the back end. I know that some operators have done that. It's not a scenario we've been in. Which I think is something to be grateful for, considering that the last few years we have been, we've seen a lot of volatility and we've been at the bottom of the market cycle. So everything considered, I think we were talking to the team about this today because we were tracking our progress with the deal and the soft commits that are coming in, and we were actually saying the exact same thing. We're grateful that the trust that our community has in us, and I think a lot of that falls back to the education we do, where people understand what the data is and they're making data-driven decisions. So we're in a very, very strong position. Class A is nearly full. I think Class B is at 75% in terms of soft commits. And so which is why we have the deadline for soft commits, so that we're now able to go in and serve everyone who's actually soft committed. So I do not foresee that.
Yeah. And I guess I'll stack onto that just conceptually, right? And so if LPs can't fill the gap and GPs can't fill the gap, right, then you've got to look to gap funding. And so there's a couple providers out there. The downside is it eats into returns, investor returns, until they can get that gap closed. So, but like Param said, hasn't really been an issue for us, despite some of the large capital needs for some of these projects. But yeah, we're very grateful in that regards.
Awesome. I think we're at the end of the questions, Tommy. And so, yeah, awesome. Okay, guys, thank you so much. And like I said, If you went on to gwcapital.com/Nashville, the slide deck's on there. This replay will be on there. If you, if you're a partner or you want to review it, you'll have access to it along with the original webinar that we did. And then if you want to book a call, there's a link on the gwcapital.com/Nashville page where you can book a call specifically have questions about this deal answered. And like I said, if you're not sure whether Class A or B makes sense, or if you're not sure how much to put into it, we're more than happy to walk through your asset allocation, your goals, and the capital that you have for the year and how you should be. We can make suggestions and help you walk through that decision-making process. We're just here to support you. Okay, awesome. Thank you, Tommy. Thank you, Adrian.
Awesome. Have a great night, everybody. Thank y'all for coming. I recognize y'all probably have a lot better things y'all could do on a Thursday night, but y'all chose to hang out with us, so appreciate it.
Yes, it's so nice to see so many familiar names on here. Just going to take a second to say hi. Hi, Jay. Hi, Rakesh. Nice to see you on here. Solomon, Swapna, you're still on. Anna, Alex, nice to see you guys. Okay. Awesome. Okay, everyone. Thank you. Hey, Bill, how are you doing? Jeanette, I saw you hop on really early. Thank you for staying. Okay, Tommy, thank you. Adrian.